The U.S. Federal Reserve is coming after your job, your money, and your home equity. What the? Well, that's tongue-in-cheek, but it's close to the truth. When U.S. Federal Reserve Chairman Jerome Powell announced Wednesday that the Fed was going to raise the Fed funds rate another 75 basis points, no one was surprised. In fact, the markets had already baked in that increase, although there was some speculation that the rate hike might be 50, 75, or even 100 basis points, or between half to a full percentage point. Yet the consensus going in was a 75 basis point increase, and Powell did not fail to deliver. But underlying these continuing increases are the reasons why the Fed wants to increase the Fed funds rate and correspondingly reduce the Fed's balance sheet. And this goes far beyond what you're likely to hear in the public or even social media. What you're hearing in the mainstream press is that the Fed wants to bring down inflation, and as everyone knows, inflation is high. So what the Fed's doing is a good thing, right? Well, once you learn how painful the Fed's actions are going to be, you may change your mind. The Fed's machinations may be worth it in the end, but what they're doing is going to hurt a lot. After some initial remarks in this video, I'm going to provide some commentary to Chairman Powell's speech this week. And I'm going to do that because knowing what the Fed is up to will help you to make wise decisions about your personal financial situation and about purchasing a home either now or in 2023. Hi, this is Robert C. Baker with United Real Estate Experts, and on this channel, Move to Chattanooga, we talk about all things related to real estate in the greater Chattanooga, Tennessee area. And if you're looking for a real estate agent in the greater Chattanooga, Tennessee area, just give me a call or text at the number listed on the screen, or if you're looking to buy or sell anywhere else in the country, contact me at the same number and I'll be happy to give you a referral. Doubtless you're aware that the Fed's continuing increases in the U.S. Fed funds rate has severely impacted the U.S. housing industry. We see that especially in mortgage applications continuing to plummet as mortgage lenders continue to panic and as mortgage companies continue their worker layoff plans. Don't you just love alliteration? For example, decreased loan volume has caused Wells Fargo to put plans in place to reduce its staff, with some folks already let go in April. And now with further declines in loan applications due to buyers walking away because of high mortgage interest rates, Wells Fargo is preparing for the worst. The bank had about 18,000 loans in its retail origination pipeline in the early weeks of the fourth quarter, but that is down as much as 90% from the year earlier when the COVID pandemic-fueled housing boom was in full swing, at least according to CNBC. And that's just one lender. Even more, there's been a slew of companies taking a hard look at their financial future, and they're not liking what they're seeing. Here we're talking about tech companies, and it's not just Twitter. Hi Elon. Other companies like Lyft, Opendoor, and Stripe has also announced layoffs. Why layoffs, you ask? Well, they're looking at 2023 and they're seeing a recession. Now, companies don't lay off employees unless they're trying to save money or they believe bad times are coming, or both. So something's up, and Chairman Powell's comments may give us a clue. Let's now listen to some of the comments Powell made on Wednesday, then I'll give you some commentary about what the Fed is looking at as it continues increasing the U.S. Fed funds rate, and you may be shocked at what you hear. And be sure to stay tuned because I'm going to share with you 3 tips that you need to do right now in preparation for the lingering effects of the Fed's actions that may impact your job, your savings, and your home equity. Here's Chairman Powell.
Today, the FOMC raised our policy interest rate by 75 basis points, and we continue to anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive stance of policy for some time.
So these comments follow a brief introduction. Powell is emphasizing that the U.S. Federal Reserve is going to stay the course. It is fully aware about high inflation, and when Powell talks about price stability, he's talking about inflation. Furthermore, the Fed is fully aware about the impact inflation is having on the economy, and it's fully committed to reducing inflation to 2%. Notice what he said. Restoring price stability will likely require maintaining a restrictive stance in policy for some time. So they're not going to change course. Now, a little bit later in the presentation, he does mention some minor tweaks in the Fed's approach. They're going to take into consideration the cumulative effect that their tools are having on the economy, as well as the lag times involved as those tools begin doing their work. And he's also going to hint at the possibility that, as the Fed takes a look at how their policy is impacting the economy, how the size of future increases in the Fed funds rate will play out. But on the topic of the size of further increases, increases, Powell was entirely non-committal. They're basically going to review everything going forward. And you should know that some folks, including members of the Federal Reserve, are thinking that the Fed funds rate will go up either 75 or 50 basis points in December, followed by 50 or 25 basis points at subsequent meetings in the new year. Now here's the first time that Powell mentions housing, and it's within some general introductory comments about the economy.
Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates.
So this is the first time that he's mentioned housing. Tightening of economic policy, specifically the Fed funds rate increases, while not directly affecting mortgage interest rates, have had an impact. Everyone knows that mortgage rates have skyrocketed. Now in the next clip, Powell is going to state the Fed's mandate to maximize employment and to stabilize prices. Now prior to this, Powell has spent some time outlining the lowest unemployment rate we've had in 50 years and other statistics regarding employment. Why so? Because the Fed needs the unemployment rate to go up in order to curb inflation. So ironically, to achieve stabilization in prices, that is to lower inflation, which is part of the Fed's mandate, the Fed needs folks to lose their jobs, which goes against their mandate.
The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation.
Next, Powell will recognize that its policies, that is, the raising of the Fed funds rate, has had an effect on the economy, but it takes time for the full effect to be realized. Notice again that he mentions housing.
Financial conditions have tightened significantly in response to our policy actions, and we are seeing the effects on demand in the most interest rate sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation.
Now you may be asking yourself, when is all this rate hiking going to slow down or stop? The Fed will eventually stop raising the Fed funds rate, and before then it will even slow down, that is, increase the rate in lower increments.
As I've said in the last two press conferences, it will become appropriate to slow the pace of increases as we approach the level of interest rates that will be sufficiently restrictive to bring inflation down to our 2% goal. There is significant uncertainty around that level of interest rates. Even so, we still have some ways to go, and incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected.
But they're not going to stop until they've achieved their objective. Now, the next few comments are worth noting, and here we need some additional interpretation of Fed speak. When Powell says a sustained period of below-trend growth, he means an economic slowdown. And while neither he nor the Fed actually want to cause a recession, they are acutely aware that their cumulative actions could cause a recession. In fact, as I mentioned earlier in the video, many companies are preparing for one. And when the Fed chair mentions some softening of labor market conditions, he means rising unemployment. In fact, as I mentioned in a previous video, the Fed is counting on the unemployment rate going up as a result of their actions.
Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices in the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done.
And if there's any doubt that Powell and company are going to change course anytime soon, there's this.
It is very premature to be thinking about pausing. So people, when they hear lags, they think about a pause. It's very premature, in my view, to think about or be talking about pausing our rate hike. We have a ways to go. Our policy, we need ongoing rate hikes to get to that level of sufficiently restrictive, and we don't really know exactly where that is. We have a sense, and we'll write down in the December meeting a new summary of economic projections which updates that. But I would expect us to continue to update it based on what we're seeing with incoming data.
Now in the next clip, Powell is going to give a sustained answer to questions posed by Neil Irwin from Axios. He asks if the channels through which monetary policy work are narrowing, or as Powell rephrases, changing. That is what the Fed doing going to work?
I don't know that the channels through which policy works have changed that much. I would say a big channel is the labor market, and the labor market is just very, very strong, very strong. And households, of course, have strong balance sheets. And so we go into this with a strong labor market and excess demand in the labor market, as you can see through many different things, and also with households who have strong spending power built up.
Notice how Powell focuses on two things. First, high unemployment, which he's spoken about quite a lot in this meeting, and personal savings. Yes, the Fed believes that the unemployment rate is too low and that stimulus and unemployment money that you've been saving is too high. That's what he means by households who have strong balance sheets or households who have strong spending power built up. Note also that he says the housing market needs to get back into a balance between supply and demand. That means that housing prices need to go down.
You know, we look at housing, of course, housing is significantly affected by these higher rates, which are really back where they were before the global financial crisis. They're not historically high, but they're much higher than they've been. And you're seeing housing activity decline, and you're seeing housing prices growing at a faster rate, and in some parts of the country declining. You know, I would say the housing market was very overheated for the couple of years after the pandemic as demand increased and rates were low. We all know the stories of how overheated the housing market was, prices going up, many bidders, no conditions, that kind of thing. So the housing market needs to get back into a balance between supply and demand. We're well aware of what's going on there.
Is this starting to make sense? And in this clip, Powell's answering a question from Chris Rugaber from the Associated Press about the Fed revisiting its internal lagging indicators or statistics and models on housing that the Fed uses to determine policy. Now that's a very important question because private real-time data, as Rugaber calls it, is declining home sales and other statistics that you and I hear or read about online or in the nightly news. Powell's answer is that the Fed is aware of those private statistics, declining sales, declining home prices, and so on, but it will continue to use its own methodology to determine how housing impacts inflation as measured by CPI or PCE.
The private measures are of course good at picking up at the margin the new leases, and they tell you a couple things. One thing is I think right now, if you look at the pattern of that series of the new leases, it's very pro-cyclical. So rents went up much more than the CPI and PCE rents did, and now they're coming down faster. So the implication is that there are still, as non-new leases roll over and become and expire, right? There's still in the pipeline. There's still some significant rate increases coming. Okay, but at some point, once you get through that, the new leases are going to tell you that what they're telling you is there will come a point at which rent inflation will start to come down. But that point is well out from where we are now. So we're well aware of that, of course, and we look at it. And but I would say that in terms of what the right way to think about inflation really is to look at the measure that we do look at, but considering that we also know that at some point you'll see rents coming down.
Now, Chairman Powell did speak to a possible recession, but only briefly.
No one knows whether there's going to be a recession or not, and if so, how bad that recession would be. And our job is to restore price stability so that we can have a strong labor market that benefits all over time, and that's what we're going to do.
So, we know that the Fed's actions are going to tighten credit, and that's going to impact you, especially if you apply for a loan. And tightened credit is also going to put pressure on companies to find ways to reduce costs. Since for most firms, a huge cost is personnel or human resources, that's often the first cost that managers and corporate execs look at to cut. And that means fewer hours and more layoffs, so jobs. How about money? Well, you're already spending more every time you go to the grocery store or the gas pump, so if the Fed is successful in bringing inflation down, you're going to see some relief in lower prices, especially when the effects of the Fed's actions have had sufficient time to work their way through the economy. But that's not going to be this winter or even the spring. It's going to take some time. Perhaps we'll have some relief in mid or late 2023. That said, an upshot of higher interest rates is, of course, if you're looking to invest the excess cash that Powell says that you have, you're going to see higher interest rates on savings accounts, CDs, government bonds, and treasuries if you want to invest in those instruments. A lot of folks, particularly retirees, will benefit from higher interest rates because the bulk of their investments are often in low-risk, government-secured investments, and so a higher interest rate environment will be good for their pocketbook. On the other hand, higher interest rates may mean some pain for folks with heavy credit card debt, high car payments, home equity lines of credit, and other forms of debt that rely on the Fed funds rate to determine the interest rate for those products. If the Fed funds rate goes up, your interest on those forms of debt will also go up. And what about home equity? Well, Powell put it quite bluntly, the housing market needs to get back into a balance between supply and demand. The housing market has been overinflated. Prices need to come down, and the Fed's actions will influence the economy so that mortgage interest rates will continue functioning at a high level. That means that we're not going to see mortgage interest rates come down anytime soon. That is, unless something happens, such as the unemployment rate reaching 4.4%, which is actually what the Fed projects for 2023 and the following year. And so the Fed is going to keep on keeping on, and that means home prices are going to fall, mostly in those areas that have had tremendous increases in home values the past couple of years. Does that mean that home prices will fall everywhere? Absolutely not, but we may see some decline in value in most areas of the U.S. So here are those 3 tips. Number 1, save as much cash as you can. You need to have 3 to 6 months income saved for a rainy day in case there is a recession or in case there are further disruptions in the labor market that may affect you or your household. If you already have that much set aside, save more. Do it because once this cycle of Fed tightening is over, and once the stock market and housing market have experienced their effects, you might have some investing opportunities. Number 2, pay down or pay off your credit cards, and as much as possible, keep personal debt as low as you can. Keep your credit score in good condition by making timely payments. Further investment possibilities may be on the horizon, and you may need a good credit score to open some doors for your financial future. Number 3, consider a side hustle or starting a new business. I know it sounds counterintuitive, right? But the extra income may come in handy, you may learn something, and if we do enter into a recession, you will have a leg up on your peers when the economy starts to recover and you've already gotten a great head start. Say, are you thinking about selling your home during these interesting times? If so, watch this video next.